Welcome, and thank you for tuning in to the Advisory Group's Managing Your Wealth in 2024 workshop. Now, we feel this information can help you prepare for the 2024 months that are coming up and can help set the stage for you to reach your financial success. So let me do some introductions. My name is Brent Beverly. I'm the president of the Advisory Group. Working with me during this session is my business partner of decades, Mr. Christian Lee, and of course, Manny, one of our longtime experienced advisors. Now, all three of us are certified financial planners. And while we're the lead advisors for the advisory group, it's our tag team that's what makes the advisory group shine. We operate as a team effort for all of our activities, and we refer to us as the tag team. The advisory group is what TAG stands for, so we're the tag team. At our firm, we partner with our clients and believe that an educated client is our best client. While we'll always try our best to help you when it comes to your finances, we believe that you knowing what's going on, your knowledge is power. One of our missions is to share with clients any knowledge that can better help them or you make an informed decision. Before we begin, it's always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, investment planning. So as a comprehensive financial services firm, we try always to consider the impact of any of our recommendations we make on not just one of these, but all of these areas for our clients. And today's presentation will be focused on investment planning and equity markets, but we're also going to share with you some proactive tax planning strategies. So to get this going, let me bring up Manny Chinche. Manny?
Thank you, Brent. What a difference a year makes. 2022 was a difficult year for investors in equities and bonds. And 2023 began with a pivot in a more positive direction, which became stronger in the second half of the year. 2023 rewarded investors who made long-term choices and stayed the course. It also left us looking forward to a bright and happy new year. Stocks surged in November and December, and the Dow Jones Industrial Average reached a new record high, and the S&P 500 came within a very small percentage of also recording a new high. As you can see, 2023 was not without its ups and downs for investors. However, seasoned investors understand that equities do not move in a straight line and are long-term investments. In our terms, we like to say that the markets were fibrillating for the first 10 months of 2023. Lots of motion, lots of ups and downs, but not pumping any blood, not really going anywhere. Then November hit, and look at the rise in November and December. Once again, it's worth noting that those who stayed the course in 2020 were rewarded. And thanks to a strong year-end, the S&P 500 finished the year with a gain of more than 24%. And the Dow Jones Industrial Average ended the year up more than 13%. The year-end jump was attributed primarily to the Federal Reserve signaling that they're ready to pivot from their aggressive monetary position. According to the minutes of the last Fed meeting of 2023, Fed officials indicated that a lower benchmark rate would be appropriate by the end of 2024 due to the clear progress of inflation reduction. However, it was still indicated that they remain vigilant and will adjust interest rates accordingly. In other words, if they see inflation on the rise again, they may sustain or possibly even raise rates once again until they see inflation rates moving down at a sustainable and consistent rate. Now let's take a brief look back at some of the highlights from 2023. As mentioned, 2023 ended on a high note, and investors are very satisfied with what went on. Volatility remained and continues to remain. Because of this, please remember that a well-balanced portfolio should be designed to include proper diversification to address these times of volatility. Inflation continued to move closer to the Fed's goal of 2%, but is still elevated. After the last Fed meeting of the year in December, news of possible interest rate cuts in 2024 brought a sigh of relief for many. Key indicators that economists watch are causing many to forecast that the economy is more likely to experience a soft landing instead of a major recession. So overall, 2023 was a good year for investors. We finally began seeing the fruits of the Fed's aggressive campaign to lower inflation in 2023. December's inflation rate was 3.4%, which was much lower than the June 20 high of 9.1% looking back over a year. Now, when you remove food and energy prices, it was 3.9%, again, moving in the right direction. As consumers, we feel price increases, and that's why inflation at high numbers is challenging. Now, here on your screen are some sample areas that increased in 2023. Food up 2.7%, electricity up 3.3%, shelter, whether it be renting or owning, up 6.2%, meals up 1%, and transportation services up 9.7%. What you personally experience may be different, but we use the official figures. In this case, what's provided from the Bureau of Labor Statistics. And as financial professionals, inflation is something we always keep an eye on. As you may know, bonds and interest rates move in opposite directions. When interest rates rise, existing bond prices tend to fall, and conversely, when interest rates decline, existing bond prices tend to rise. Now, thanks to a year-end surge, bond prices, which were down for most of 2023, had a historic rally, and after 2 straight years of losses, bond investors saw a positive year-end. This sudden pivot in bonds is a testament to the volatility that we saw in 2023. It also reminds us how much weight that Fed movement carries. On December 29th of 2023, 5-year Treasury notes yielded 3.84%. 10-year notes yielded 3.88%. 20-year notes yielded 4.2%, and 30-year notes reached 4.03%. The 20-year Treasury note yielded as high as 5.3% on October 19th of 2023. Now, we will continue to closely monitor how the Fed's movements and how rising interest rates are affecting bond yields. With the Fed's anticipating interest rate cuts in 2024, this may narrow the opportunity to get lower risk, higher yielding bonds. And if you'd like to explore how bonds could fit into your retirement income strategy, please contact us so we can help you make the best decision for your portfolio. Safety comes with a cost, and even though interest rates have risen, many major banks are still averaging low interest rates for savers. According to Brent, average bank money market rates on December 29, 2023 were still only 0.6%, and the average 12-month CD rate was 1.94%. They have increased significantly in the last 12 months. However, savers are still seeing lower returns. And for anyone who's interested in exploring better interest rate options, again, please contact our office. As we enter 2024, we stand by our mantra of proceed with caution. Interest rates and inflation will continue to be the top factors in the direction of the economy and equities. Other factors remain key players in the direction of equity markets. 2024 is a presidential election year, and a particularly raucous one at that. A change in cabinets could signal major changes in the economy and tax law. However, please remember, changes in law take time, and sometimes they do not go into effect immediately. And we're also still seeing geopolitical unrest in the Middle East and the ongoing Russia-Ukraine war. Tensions with China will also remain a concern. The global economy will also continue to be in a precarious position in 2024. Equities do not like geopolitical or global economic uncertainty, so we will continue to keep an eye on how they may affect the equity markets. And as your financial professional, we are committed to keeping you apprised of any changes in activity that could directly affect you and your unique situation. Now, we have all heard the term soft landing, but what exactly does that mean? In a soft landing, we experience low unemployment rates with low inflation. During a recession, we see high unemployment rates and low inflation. During a stagflation, we see high unemployment rates coupled with high inflation. Thankfully, most analysts are looking forward to a soft landing. Now, just because we may see a soft landing doesn't mean the cost of everyday items we depend on will go down to pre-pandemic prices. Unfortunately, when prices go up, we usually don't see them go back down much. That being said, investors will need to understand and keep up with rising prices, and that can cause cost of living adjustments. After a year in which 4 of 8 Fed meetings saw interest rate increases, we ended 2023 with 3 straight rate hold sessions. The Fed did not raise interest rates in the fourth quarter of 2023, and they remained in the target rate range of 5.25 to 5.5%. During the Fed's December meeting, it was also indicated that we could see several rate cuts in 2024. To date, we have not seen any rate cuts so far this year. At the first FOMC meeting of 2024 on January 31st, the Feds announced that they would keep rates unchanged, giving us now 4 consecutive rate holds, which is being well received by investors. Also during that January meeting, Fed Chairman Powell said that while rates have likely reached their high, a March rate cut doesn't look likely, but we should see a rate cut at some point this year. There are 7 more scheduled FOMC meetings in 2024, and although it is currently anticipated that rates will go down, the Fed remains committed to achieving the 2% inflation rate goal and intends to adjust rates accordingly should inflation pressures have a resurgence. So, what has historically happened with equities when the Fed cuts rates? As we can see here on the screen, the S&P 500 has an average gained, particularly when there was a soft landing, which is what most economists are anticipating. So let's be hopeful that this time we see something similar. However, of course, please remember past performance is no guarantee of future results. One of our primary goals is to help our clients make more informed financial decisions, which could lead to better outcomes. So let's take a few minutes to go over some key 2024 items to look out for. With the continued downtrend of inflation, the potential for interest rate cuts, and a healthy labor market, investors are hopeful and thinking positive for 2024. Recession fears have significantly diminished, and a soft landing or a shallow recession appears to be more possible. 2023 rewarded long-term investors, and we stand by our belief that investing in equities is a long-term commitment, and we're still recommending equities as a long-term investment. Regardless of what 2024 will bring, it is always prudent to watch your expenses and make smart money and investment decisions. We believe in proactive preparation, and our goal is to provide you with a solid financial strategy that is carefully designed to survive any market environment. Heading into a new year, we believe that volatility could still be prevalent and that investors should be cautionary in any financial decisions. Again, a long-term strategy and measurement needs to be the benchmark for smart investors. So what should investors be looking for in 2024? Well, inflation is likely to settle. The International Monetary Fund is forecasting that the U.S. will see an inflation rate of 2.3% in 2024. Because of this, look for interest rate stagnation or even a reduction. The cost of borrowing is still elevated. We suggest that you actively pay off all non-essential interest-bearing debt and maintain liquidity for short-term purchases. And if you can hold off on any purchases that will require you to take out a loan until we see rates reduced, we recommend you do so. Having a solid investment strategy is an integral part of a well-devised holistic financial plan. We help clients create a well-crafted plan customized for their unique situation and goals that takes into consideration how each client will react to the ups and the downs. We consider many variables, including your time horizon, tax implications, liquidity needs, risk tolerance, and overall personal objectives. Now, just because things are looking up, this is not the time to become complacent or make risky decisions. Caution should still be the principal notion for investors. Again, we feel the best strategy is to stay the course and focus on long-term investing strategies. And as always, we're here for you. As stewards of your wealth, we're here to help you pursue your goals. And if you'd like to revisit your financial plan or discuss any concerns or ideas, please call our office or bring them up at your next scheduled meeting. Now, to discuss tax planning for this year, allow me to bring up Chris. Chris?
Thank you, Manny. Let's talk about tax planning. We feel it is important to remember that proactive tax planning should always be a key focus when reviewing your financial situation. We believe that a proactive approach to looking at your tax situation can lead to better results than a reactive approach. Tax laws seem to always be changing. Legislation like the Secure 2.0 Act made significant changes that could affect your 2024 taxes and beyond. One of our goals is to point out as many tax savings opportunities and strategies as possible for our clients. Let's briefly review some broad tax information and some potential tax reduction ideas. Please remember that not all ideas may be appropriate for your personal situation. This information is for informational purposes only, and we always recommend that you address any tax strategy with a tax knowledgeable professional. Let's look at some helpful proactive tax planning strategies. Key 2024 tax information. The IRS has already released 2024 tax brackets. There are still 7 federal income tax brackets, which have been slightly adjusted from 2023. Long-term capital gains are still currently scheduled at favorable rates for 2024. Contributing to a retirement plan for those who can is always helpful. In fact, it's never too early in the year to start contributing to your retirement plan. Here are the current 2024 retirement contribution plan limits. Some have increased for 2024. If you have any questions about your retirement plan, please give us a call. You might want to examine taking advantage of annual exclusion gifts. For 2024, the maximum amount of gift tax exemption is now $18,000 per person. For example, you can give that amount to a family member without having to pay a gift tax. Here are some ideas of the annual gifting. How about contributing to a working child's IRA? Or gifting to a 529 plan, which is a tax-sheltered plan for college expenses. Proactive tax planning strategies because, as we said earlier, we believe that taking a proactive approach is better than a reactive approach, especially regarding income tax strategies. Your objective should be to minimize your taxes whenever possible. The Enhancing American Retirement Now Act, more commonly referred to as Secure 2.0, was voted into law as 2022 closed. It is one of the largest bills ever to address the retirement crisis in America. It was designed to help boost the retirement system, making savings for retirement more accessible to a wider range of Americans. Most of the Secure 2.0 Act changes started in 2023, and many of the rules were clarified recently. The original 2019 Secure Act changed the required minimum distribution age from 70.5 to 72. Then, the Secure 2.0 Act pushes it even further to age 73. This new change starts with your 2023 taxes, with distributions now required to begin by April 1st of the year after you reach 73. The new legislation also sets the required minimum distribution age to 75 in the year 2032. The penalty for failing to take an RMD will be reduced to 25% from 50%, or 10% if a timely correction is made. This rule started in 2023. Roth provisions are ones which our clients have been attracted to for many years. The Roth SEP and Simple plans were allowed starting in 2023. In addition to some catch-up contribution allowances, another nice feature of the Secure 2.0 Act will be the option to convert unused 529 plan funds into a Roth IRA. This feature begins this year. The qualifications for this are complicated, including that the 529 plan must have been in existence for 15 years or longer. After 15 years, any unused 529 plan assets can be rolled over to a Roth IRA for the beneficiary. This is subject to Roth IRA contribution limits and an aggregate lifetime limit of $35,000. This rollover will be treated as a contribution towards that person's annual Roth IRA contribution. The annual limits applying. We're mentioning this item today as a courtesy. This strategy is something we can discuss for those whom it might be appropriate. All of the specifics have yet to be finalized. A critical area to review in tax planning for your retirement accounts is what we refer to as overall family tax bracket management. If you have retirement assets that are not in a Roth IRA, then when and who takes distributions can make a huge financial difference from an income tax standpoint. Simply put, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions in their tax bracket rather than you accelerating them in yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your bracket, pay the tax, convert these accounts to Roth IRAs, and leave them the Roth IRA. The Roth IRA account still must be taken out in a 10-year period, but can grow tax-free for up to 10 years. A key step that we like to start with to help clients look at minimizing tax is to compare your marginal tax rate with that of the beneficiary's marginal tax rate. We like to do this each year. This is something we try to think about for our clients, especially those with large retirement accounts. Especially now with the Secure Act's 10-year rule. For some people, exploring a Roth IRA conversion could be helpful. Some benefits from Roth IRA conversion include they could lower your overall taxable income long term. Roth IRAs enjoy tax-free compounding. There's no RMD like with a normal IRA at age 73. Roth IRAs allow tax-free withdrawals for beneficiaries. Partial or full Roth IRA conversions are not for everyone. Whether you convert part or all of your traditional IRA to a Roth IRA depends on your situation. Before doing so, it is best to prepare a tax projection to calculate the appropriate amount to convert. Like with many financial decisions, there are several pros and cons to making this change. Please call us or talk with your tax advisor to see if this makes sense for you. For those of us who are close to the standard deduction level, a strategy to consider is bunching your charitable donations into a donor-advised fund. For example, someone who is slightly over the standard deduction each year can bunch 3 years of charitable contributions into a donor-advised fund and deduct them all in 1 year. This could bring that taxpayer a much larger overall tax savings over, in this example, the 3 years. Then, from their donor-advised fund, they can give their favorite charity money each year. Now is the time to explore if this is helpful for your tax situation to deposit cash, appreciated securities, or other assets into a donor-advised fund, and then distribute the money to charities over time. For more information on this strategy, please reach out to us. Did you know that you could give to charity from your qualified retirement account? Qualified charitable distributions can be a tax-advantaged gifting strategy for retirement savers. The QCD provision allows retirement savers to directly distribute up to $100,000 to eligible charities straight from their retirement accounts after age 70. This gift does not incur tax on this distribution. One idea that experts suggest, if you are charitably inclined, is to consider using part or all of your required minimum distribution to make this QCD. Like many of the other strategies we are discussing today, this is one you should see us about if you're interested, and we will evaluate your situation. The Tax Cuts and Jobs Act bill was signed into law on December of 2017. Most of the changes that were made in this bill are scheduled to expire on December 31st, 2025. Congress could extend some or all of the provisions beyond 2025, but as of now, the sunsetting of these changes is still intact. This is a subject we anticipate discussing with clients and friends later this year. Again, we feel taking a proactive approach to looking at your tax situation can lead to better results. Please look for or ask for our special tax report that provides useful information for filing your 2023 taxes, as well as proactive tax planning tips for 2024. One of our goals is to constantly educate our clients, so please connect with our office and we will mail you this report. We will mail it to you or to anyone you feel may benefit from this information. To take us to the end, let me bring back up Mr. Beverly. Brent?
Well, thank you, Chris. We've covered a lot in this presentation today. So, of course, there are important disclosures that need to be made. Please pause your viewing until you're clear, you've had a chance to read them, and you're clear on what these disclosures say. We want to thank you for viewing this presentation. We trust you found this helpful and informative. And remember, at our firm, clients come first, and your health and well-being is our highest priority. If you have any questions, if there's anything you want to follow up on, please reach out to us. Thank you again for viewing the presentation. For everyone, we hope you have a wonderful, safe, and healthy 2024 and beyond. Thank you so much.